Okay, seems like I have been able to control, so we can start. Yeah, let me share my screen so that you can all see what we're going to learn today. So we're going to start looking at the source documents. Hopefully by the end of today's lecture, we shall have finished the source documents. You will get the document that I'm going to use afterwards, and there are some examples for you to work out. That means that come your lecture on Wednesday, you should be ready to continue with, we should hopefully continue with the journals or the ledgers. Last week, we finished with double entry, and I hope you know what to do. So for today, we're going to first look at the source documents, what are they? And then we're going to look at examples of source documents. And then we're also going to discuss the information that is found in the source documents as well, and what information is relevant for what particular entry. Now, what is a source document? A source document is basically evidence. I hope you remember the accounting concept, specifically the accounting concept of verifiable objective. If you remember the concept of verifiable objective, which basically says that any transaction that takes place should have evidence that it took place, and that evidence can be traced in source documents. Now, what is a transaction? A transaction basically, yes, did we look at that? No, we didn't look at it. We shall define what a transaction is later on, but basically, when the transaction occurs, there must be evidence that this transaction has occurred, and that evidence can be found in what we call source document. There's so many different types of source documents, but we shall look at a few of them, and then I will give you a summary at the end of the lecture of a few other source documents that you can look into that can enlighten you about what other things can entail. But the specific ones that we need for our journals, we're going to look at them today. Okay, so the source document, what are we looking out for? We're looking for the business name or the other company or the second party that you did business with, the date that the transaction took place, description of the transaction in terms of what are the goods, what type of goods are they, and also the value of the transaction, which could be either the price at which you sold the goods or the cost at which you bought the goods. So in review, as we looked at in the first week, we said accounting is a process, specifically financial accounting. Financial accounting is a process, and it is made up of 6 stages. And the first one is the occurrence of a transaction. So when a transaction occurs, what do we do? One, remember a transaction must be in monetary terms. You remember the money measurement concept. I hope you do remember these things. This transaction occurs, and after it has occurred, we get the source document and then put into our records or our books this particular transaction. So we do that through a process that we call journalizing. Okay, that is documenting or recording of a transaction. That is what we're going to look at. And then afterwards, at the end of the month, usually, we post these records into what we call the ledgers. Now, what we did last week was the double entry into a ledger. And I hope all of us did some revision on double entry. So what we did was post into the ledgers. Now we're going to go a little bit back into how the transaction occurs, where it is recorded, and how it travels all the way into the ledgers. After we do that, we look at the fourth stage of the accounting process, which is drafting the trial balance. So those who were in class last week also, we looked at a simple trial balance and how it is extracted from the ledger accounts. Now, when you look at stage number 5, end of year adjustment, there are certain transactions that do not appear in our books, simply because one, they probably have been incurred. I hope you remember the accrual concept. They have been incurred, but they have not been paid. Or sometimes we have actually received cash, incomes, you have received cash, and this cash has not yet been provided the service for. So for example, somebody pays you money in advance for a certain service and you have not yet provided the service. That means that somebody has paid their money for this financial year, but the service has not yet been provided. So it cannot be put into our books of accounts. I hope you remember the matching concept. We have to match the revenues to the costs for an accounting period. So in other words, we must remove those transactions that do not relate to this accounting period. And we do this at the end of year adjustment stage. Then we have other transactions that, for example, Balunji Agnes, please mute your mic. If I have to go and mute your mics all the time, we shall waste a lot of time. So as I was saying, that there are certain other transactions that we provide for at the end of every accounting period. For example, depreciation. And those who were in my class, you remember we said that depreciation is the value that you attach to a non-current asset over a period of time. So in this particular year, you have to calculate the depreciation. The next year, you have to calculate depreciation or the value of that asset for that particular year in order to adhere to the matching concept. You match the expenses to the revenues in that period. And some of those things are things like depreciation. Then sometimes we want to dispose of our assets at the end of an accounting period. Probably their useful life is done and the asset is more of something that is in diminishing returns and not optimal for efficiency or effectiveness of running the business. So we want to dispose it off. This we also do at the end of the year. So there are some end of year adjustments that we look at: prepayments, accruals, depreciation, disposals. Maybe there are some bad debts that we have to write off, people who are not going to pay their debts, the debtors, you remember the debtors. So this is at that stage, stage 5 is where we do all those things. And then after, we get a new trial balance, which we use to prepare our financial statements. And briefly about the financial statements, we looked at the accounting equation. I hope you remember your assets should equal to your liabilities plus capital. But that particular equation can also change. It could be liabilities is equal to assets minus capital. So you play around with the equation, but mathematically it should always be assets equal to liabilities plus capital. But if you have capital and you're told if you have the capital and you have the assets and you're told to find the liabilities, then you know how to play around with the equation in order to do that. It is simple mathematics. I hope you are practicing with other questions, because accounting is all about practice. You must practice, practice, practice until you get it. And on that note, I would like to continue to what is a transaction? A transaction is basically an event that takes place. But this event, using the monetary concept, must be in money form. So, or it must be in monetary terms. And this transaction is recorded in our books of accounts. So that is basically a transaction. Now, where does the transaction get first recorded? We record the transaction first in what we call books of original entry. These books of original entry in certain books are also called subsidiary books or journals. That is where the transaction is first recorded. Okay. Let me just go to my mute mic. All right, we can continue. Yes, as I was saying, the first place where a transaction is recorded is what we call books of original entry, also called subsidiary accounts, subsidiary books, also known as journals. And the process of recording these books, of recording these transactions in these books is called journalizing. Okay? This here, it's called journalizing. I hope you can see. I wrote it in the first accounting process. The process of documenting or recording a transaction is called the journalizing process. We do the journalizing process in the books of original entry, also called journals, also called subsidiary books. Now, after that, we go through a process that we call posting. We post to ledgers, and we looked at some ledger accounts last week. So we post the summary in the subsidiary accounts or in the journals. We post that summary into the ledger accounts. Now, when it comes to the ledger accounts, that's where the double entry comes in. That's where we debit and credit, debit and credit, debit and credit. And I hope you remember the debit is the left and the credit is the right. And I hope you remember the transactions which have their normal balances on the credit side, and the transactions or the events that have their normal balances on the debit side, the assets, the expenses, the drawings and the dividends on the debit side. And then on the credit side, we have sales capital and liabilities. I hope you remember these simple things. If you do not, please go practice, 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 and practice. Now we're going to look at the types of source documents, or those documents that show evidence that a transaction has taken place. Now, the first document that we're going to look at is what we call the invoice. In other books, this particular source document is called a bill. For instance, when you go to eat somewhere, okay, you go to have lunch or you go to have dinner, they will give you something called a bill. This is the basis upon which that particular restaurant or that particular hotel is claiming money for, okay? So you have consumed and now they are billing you. That bill is also called an invoice. Are we together? So for certain things like purchase of goods, you will get an invoice. For things like services, consultancy services and so forth and so on, or restaurant services, you will get what we call a bill. That document shows that there's a claim of money regarding goods that have been sold on credit. That means you have not yet paid for them, okay? Now, it could be credit sales, and that is specifically for debtors. So you get what we call a sales invoice, or it could be on purchases from creditors, and therefore you get a purchases invoice. Now we're going to look at a sales invoice. What does it look like? I have tried to put in certain pictures of what these documents look like. I know that sometimes people go out in the world when they have never seen these documents. So I try to put as many documents as possible for you to relate to what you're learning. So a sales invoice can look like that. Now remember, a sales invoice or any of these source documents should have a business name. They should have a date of transaction. They should have the description of the transaction. They should have a specific value of the transaction, okay? So in this case, we have a sales invoice from a company yet to be written here. And then we have a date. We probably have a sales number. Unfortunately, the online learning, you cannot see what I'm pointing at, but you can see the picture. And then we shall write the name of the customer, the address of the customer, where they come from. And then we shall write the period, probably the month, the description of the goods that we have sold, and then the unit price of the goods and the total amount of the goods. As you can see below, there's an authorization for this sales invoice. Because the goods are being given on credit, they must be authorized. And then the date, also the title of the person, the contact, and the authorized signature. Now, a sales invoice is prepared for debtors. Okay? When somebody comes to buy goods from you on credit, they become your debtor because instead of giving you cash, you have received an asset called a debtor, which can easily be liquidated into cash. Okay? So you give them what we call a sales invoice. Now, this is also known as an outgoing invoice. So it is going out of the business to a third party or to a second party, whatever you would like to call it. How do we record this particular transaction? This is the source document. The sales invoice is the source document upon which we are getting information. That means we have made sales on credit. What happens when we make sales on credit? We open up a book, a subsidiary book, or a journal that is called a sales day book. Also, it is called a sales journal. Yes, Nyakato Diana, you can unmute yourself.
I beg your pardon, madam.
What is
Sales invoices are recorded in what?
Please look at my screen. I'm sharing my screen. I hope you can see my screen.
Yes, I do.
Yes, we record the credit sales in what we call a sales day book, also called a sales journal. Are we together, Diana?
No.
Are you looking at my screen?
Yes.
Because it is written there.
So
You
I'm
record
seeing
in
sales
the
invoice.
sales day book. What can you see?
Sales invoice prepared for debtors to claim money for goods sold on credit. Then it is recorded in the, yes, I can see it. Recorded in the sales day book.
Okay. So the source document is the sales invoice. We shall get the information from the sales invoice and record it in a journal called the sales day book. This book is also called the sales journal. Now, how do we record this in the sales journal or the sales day book? This is basically a book to record credit sales. Okay? We shall go, please look at my screen. I have put there the format of the sales day book. In the sales day book, we find a date. We find the name of the customer. In this case, it will be a debtor. So the name of our debtor, we have Jackie. And then we also have an invoice number upon which we sold the goods to Jackie. And then we have the folio, which is also usually a reference number, and the amount at which we made the sales to Jackie, Jackie being our debtor. So that is the format of the sales day book or the sales journal. If you're asked in a question to draw up a sales day book, the things you must remember: one, the format, and two, the sales day book is only for credit sales. So it's not for cash sales. We shall see where we record the cash sales. Who's not? Okay. Yes, that's muted as well. Somebody, please mute your mics. Otherwise, I'll waste a lot of time trying to find who you are and try to mute you instead of actually teaching. Okay. When you draw up a sales day book, there are two things to remember. One, the sales day book, also called the sales journal, records credit sales or sales on credit, sales that you have made on credit. Secondly, it has a format. What is the format? I have given it to you on the screen. You put in the date, you put in the date, you put in the name of the customer, you put in the invoice number against the sales invoice, and then the folio number, and then the amount. Okay? The folio number is a reference number. After you have done this, please listen very carefully. What we have done by recording in the sales day book is what is called journalizing. After journalizing, at the end of the period, so on May 1st, we have Jackie. So you could find that on May 2nd, we have another data called Peter. Then maybe on May 5th, we have another data called Jen. All these, you add them up and make a summary. After that, you have a total of your data. After the period, you have a total of datas, and you will find the total of the datas in the amounts column. What you shall do is you shall post. Now, after the period, we post our entries that we have made in the day book into a ledger. You remember last week I told you a ledger is like a normal book. It's a normal book with many different pages. So you could have a page in that ledger that is specifically for data. So it is a data's account. It shows your total data for the business. So you will go to that page specifically for data, and you will record the data for the period. So in this case, we have our data being a total of 400, just one data called Jackie. So at the end of the period, we post to the ledger account called the data. So we debit the data's account with 400,000. Remember, data's are assets, that's why we debit them. And we credit our sales with 400,000 because we have sold goods. And remember, our sales accounts have credit balances. When sales increase, we credit. When assets increase, we debit. And that is what has happened. We have got assets called debtors, and we have made sales. Now, there is an example there that I am going to leave to you to do, okay? The next page is an illustration or an exercise for you to do to draw up a sales day book or a sales journal, okay? Now, the first transaction, which is Jackie, on May 1st, we sold goods to Jackie for 400,000 and the invoice number was 0111. That transaction has been recorded for you here. I have done it for you. You can see it on the screen. Just follow that format and complete the sales day book. So there are only 4 transactions for you to put in. Please do that exercise in your own time. Now we're going to look at what we call the purchases day book. The purchases day book comes from the invoice source documents. The invoice source documents for credit purchases or the purchases that you bought on credit, or goods that you bought on credit, or stock that you got on credit. We get what we call a purchases invoice. Now, remember, I told you the elements that must be on a source document. The number of the document, the date that it was issued, the company that has issued that invoice. In this particular invoice, you have what we call terms. Please pay your invoice. It's down there. I have circled it in red. Please pay your invoice by a certain date. Now, this is where things like discounts come in. So sometimes when you pay earlier, there are terms. If you pay earlier, you get a 5% discount or if you pay by this time, you get a 5% discount. So all that you can find in the terms of payment for that invoice. If it doesn't have, that means there's no discount, you still have to pay the full amount. Okay? So as usual, it gives you the description of the goods or the whatever you have bought. It gives you the unit cost, it gives you the quantity, and the quantity times the unit cost gives you the total amount. It gives you a subtotal if there's any discount, if there's any VAT or tax that has to be paid, and then the total amount of the invoice. Yes, Godwin Twesige. You can unmute yourself.
Yes, madam, I didn't get that example. You put the example, I just maybe take the example, then we go back. I didn't check the example.
You want the illustration for the sales day book?
No, the example which, okay, the question which you put.
This one.
The Jackie and
This
Emma.
one, yes. I will give you the document afterwards.
Yes.
Otherwise, we have no time for copying. Okay? We have no time for
Okay.
I will give you this document and you do it in your own time. So this is what a purchaser's invoice looks like, and we check for all those qualities that we need. You remember the name of the company, the number, the date, the description, the amount, and so forth and so on. When we buy purchases, when you get purchases, or we acquire purchases, or we receive purchases on credit, or buy stock or buy goods on credit, we record this in what we call the purchases day book, also known as the purchases journal. The format you can see on the screen. You have a date, you have the name of the creditor, you have the invoice number, the folio, and the amount. You remember that goods bought on credit are actually liabilities. So these people, we owe these people money against what we call purchases. So at the end of the period, so in this case, we only have Stephen. Stephen, we bought goods from Stephen amounting to 1.5 million on the 3rd of May. There could be also other people, maybe on the 5th of May, on the 10th of May, on the 25th of May, and then on the 28th of May, and then we draw up a total. We transfer that total to the ledger by a process called posting. So we post this total to the ledger account or the ledger page. You remember our book? We have a ledger page. On that page, we record creditors. Creditors are liabilities, and because they are liabilities, when they increase, we credit. So we shall credit our creditors account with 1.5 million shillings, and then this is against an asset that we acquired or a resource that we acquired in the business called purchases. You remember that sometimes we use liabilities to acquire assets in the business. In this case, we have acquired purchases, and we have acquired purchases using a liability called credit. So we shall debit our purchases, which is an asset, and credit our liabilities called creditors in the ledger through a process called posting. I will continue. So on the next page, I also give you a simple illustration for you to run through or exercise in your free time. This is all about drafting a purchases day book, also known as a purchases ledger. The format is here on that particular screen. I have given you the format. What you need to do is fill out the format for the remaining entries. The first entry on 3rd May, we bought goods from Stephen of 1.5. That's the invoice number, is given to you on that screen. So you just follow the format and input those entries. Please make sure you do this homework. Now, the next source document. The next source document is what we call a credit note. In certain books, it's called a credit memorandum. In other books, it's called a credit memo. Yes, Eliab Kayongo. You can unmute yourself. Okay, Dahura James, you can unmute yourself.
Morning, madam.
Yes, please.
I wanted to ask. I wanted to ask a question. Do you have to first to put the to mix up the okay as in the invoices? Jesus, what's this? I'm using the
I
headsets.
can
But
hear you. What is the question?
I wanted to ask that you have to put Jesus. Do you have to put them in the invoice? Then you also have to put them. You also put them in the purchase ledger. Jesus.
Yes, I've got your question. Now you can mute yourself. Yes, your question is, do you put the information in the invoice and also you put it in the sales day book? No. The source document is a document upon which you get information. Okay? So that means that if you buy goods on credit, wherever you have bought the goods, they'll give you an invoice. So this is not your document. You have received the document as a source document to show evidence that you bought goods on credit, and you have not made it yourself. Somebody has given it to you, they made it and gave it to you as your creditors. So you're not the one filling in the invoice. The invoice is a document where you get information that you're going to fill in the purchases day book, okay? This particular invoice is an invoice that you make in the business. The sales invoice is an invoice that originates from within the business. So this one, you will prepare it. You will prepare and then you will send a copy to the other party that has bought goods from you, your data. You send the original copy to your data and you remain with a photocopy or the second copy or what they call the carbon copy. So in a book, in a normal book, if you look at, if you've been to any business, in a normal book, there are 3 copies. There is the original copy, there's a pink slip, and most times there's also a blue slip. These are all carbon copies of the blue slip, and the pink slip are carbon copies of the original receipt or original sales invoice or original source document. So the original source document is usually given the customer. In this case, it will be the data, and then you remain with the other copies that you will use to input into your records. This document, which is called the sales document, originates from within the business. This document, called a purchases invoice, comes into the business from your creditors. Okay? James, are we together?
yes, madam, we're together.
Okay. Eliab Kayongo, you can unmute yourself.
Oh,
Nasaka Belinda, Eliab,
I
okay?
had raised the hand because, sorry, I had raised the hand because I was not hearing, but now I can hear.
Okay, yes, Nasaka. Eliab, mute yourself, please.
I want a screenshot for the the book question. The assignment of class.
Yes, you will get the assignment after class. Dakato Diana?
Yes, madam. So am I correct when I say that the sales day book is prepared by creditors? And purchases debit by the debtors.
No, all these are books within the business, the same business. One is to record sales on credit, one is to record purchases on credit. Those are two different types of transactions.
Thank you.
Yes, Chimbowa Hamidu. Unmute yourself.
Yes, madam. I'm asking.
What is your question?
My question is, you gave an example about the sales day book and the purchase day book.
Yes.
Is it that when you're recording, are you supposed to record item per item or item per each sales day book, or you record a sales day book in a list, like the example you gave? You gave an example of 4 items. So is it that each item should have a separate sales day book or one sales day book?
Yes, I get your question. Mute yourself.
Okay.
Yes, so a sales day book, somebody is still unmuted. Who is unmuted? Please mute yourself. Okay, so a sales day book is a book, okay, and it records daily sales. So every day you will record the sales that come in. So you could find that Jackie bought goods for you from on credit, okay, on 1st. Then she came back on 3rd and still bought goods on credit. Then she came back on the 6th. These will be 3 different transactions on 3 different dates. So you will record on a daily basis. So it is not that it is a book for each data. No, it is a book that records credit sales, not credit sales for each person, but credit sales. So on 1st, you may have Jane and John and Peter. On 2nd, you may have Hamidu and Rebecca and Jen and things like that. All those people will appear in that sales day book because they are all creditors. Oh, sorry, they're all debtors. They all bought goods from you on credit. So they are debtors, okay? You will record all of them in the same book. Can I please continue? Because we do not have time. Unless you have a question that can't be answered otherwise, then you raise your hand. If it can, please find your friends and ask those questions. If it is something to do with this document, I am going to give you the document. Yes, Mwongi. Unmute yourself.
Madam, I'm on track. You can go on.
Okay, put down your hand. Wendy Rashidi.
Yes, madam, morning.
Good morning.
Yes, madam, I want you to clarify about that purchase journal. I've not understood very well about it.
Yes, I will refer you to your friends, Wendy. Please ask your friends about what they have learned about it, because it seems you were late. I spent quite a bit of time on it. Please help me put down your hand. Now, as I was saying, the second source document is called a credit note. Other books refer to it as a memorandum or a credit memo. What does a credit memo show? It shows any adjustments in the money that is claimed by either debtors or creditors. And usually it's a write down in either their debt or their credit. So sometimes they call Muchivi Shafu something, please mute. Okay, so we have what they call incoming credit notes and outgoing credit notes. Now, in certain books, the incoming credit note is also called a debit note. The outgoing is also called a credit note. So sometimes they split the two between the debit and the credit, but it could also be a credit incoming or a credit outgoing. Nixon, I will get back to you later. Now, these documents originate, the debit note originates from creditors. In other words, they show a return of purchases, what we call returns outwards or purchases returns. So it is an acknowledgement. It's an acknowledgement from your creditor that you returned goods. So let's say that your business is XYZ and you deal in, let's say you deal in stationery. And then let's say Plum Stationery sent you books. Plum Stationery sent you books, but you find that some of these books are maybe defective, maybe ink spilled into the books and therefore they cannot be sold. You cannot sell the books. XYZ cannot sell these books that were sent by Plum Stationeries, okay? So you return the goods. Remember, these are purchases that you have got from Plum Stationery. You return the goods to Plum Stationery. Plum Stationery will send you a debit note. This debit note will acknowledge that they have received the goods and they have written down your credit to a certain amount. So it has reduced. Okay? When that happens, that means that your liability to Plum Stationery has reduced. When liabilities are reducing, you remember you debit, because liabilities have a normal credit balance. When liabilities reduce, when your creditors are reducing, because you have returned certain purchases to them, then you will debit the creditors. Then you will open an account to hold those purchases returns, and that account is called a purchases outwards account or a purchases returns account. I repeat, when you return goods that you have bought, remember when you buy goods, you get purchases or stock or inventory, okay? When you return these goods for one reason or another, your creditor will issue what they call a debit note. In other words, they will tell you that they have debited your account because in your account you will debit a creditor when a creditor reduces. That is why it's called a debit note. You debit the creditor. This debit note will show that your credit amount, which you owe the supplier, has reduced by a certain amount. Now, when you get that note, which is a source document, you will go to your accounts. In your creditor's account, you will reduce the amount of liability that you owe the creditor or the supplier. When that happens, you debit the liability. And you open up a new account called a returns outwards or a purchases returns account. Now, you remember we drew up a simple income statement which had sales, less expenses to get a profit. I hope you remember the simple income statement that we drew up. Now, under the first part, which we have sales, we are going to expand it a little bit more. Under that section of sales, we have what we call a trading account, which shows the difference between your purchases and your sales. So it usually is sales less cost of sales. The cost of the goods that you're selling, and that is where purchases come in. The goods that we have purchased. Then, if there are any goods that you have returned, you deduct them. So we'll have our opening stock, then we add our purchases. If there are any purchases that we have returned to the supplier, that is where we deduct them. That's where this amount goes. That is called purchases returns. But we shall look at that, and we're going to look at that. We're going to keep building our income statements. I will send you a draft of the full income statement so that you go following each and everything. So now we've added a simple element to our income statement that we call purchases. And under that, we have deducted purchases returns. So we're going to keep building our income statement as we go on. So that is where that amount goes in our financial statements. Now, the credit note, or also called the outgoing credit memo, is sent to debtors. So when the debtors send us goods back, when they send the goods back, for example, if we sell to them goods and they are found to be defective, people have a right to return those goods to you. So when they return the goods to us, remember, these are our debtors. I was saying that the other note, which is called a credit note, okay? When we sell goods to people and we sell these goods on credit, and maybe these goods are defective, or maybe they find some goods are spoiled, they have a right to return the goods to us, okay? So they will return the goods to us, and these goods shall come with what we call a credit note, okay? This credit note shows returns inwards or returns from debtors, okay? Returns inwards into the business, or sales returns, or returns from debtors. All those are different things, meaning the same thing. What we shall do is that we'll open up our journal called a returns inwards journal, or a returns inwards day book. A returns inwards journal is also called a return inwards day book. A returns outwards journal is also called a returns outwards day book. Okay? Yes. And in that returns outwards, we shall put those details. I'll put the formats for you there. I do not have rights anymore, so let's try to mute our mics, okay? Because of the problem of somebody hijacking the meeting. That is the format of the sales inwards journal or the sales inwards day book. You fill in the dates, you fill in the details of the transaction. There's usually a credit note that comes with that particular transaction. It has a folio, for example, where it was written in the sales ledger, and then the amount. So after that, you get the total, like we did for the purchases day book or the purchases journal. Then that total is finally posted to a ledger. In the ledger, where do we post it? Because the returns are coming into the business, that means that our sales are being affected, okay? Because we made sales and we got debtors, now our sales are being affected. So we shall debit our returns inwards, and then we shall credit our debtors. Remember, our debtors are reducing because they're returning goods to us. We made sales, we got debtors. Our debtors are reducing because they're returning goods to us. So when our debtors reduce, that means an asset is reducing. When an asset is reducing, you credit the asset. And that is why we credit the debtors account, okay? And then we open up a new account, which we call the returns inwards account, also known as the sales returns account. Now back to our income statement, where we have sales, less cost of sales, where we have our purchases. Now we're just looking at that part that has sales. Once we have our sales, we less sales returns. I'm going to send you that document so that you have all this information as we go on. To build up our sales, we have sales less sales returns or returns inwards to get our net sales for the period, okay? So that is where sales return goes in our financial statements. I will send you a comprehensive statement so that when I talk about something, you know where it goes in the financial statement. Now, there was somebody with a question. Was it Nicholas? Was it Nicholas? I don't remember your name. Was it Trust? Yes, Shafiq. You can unmute yourself.
Yes, madam. I was just suggesting that if you can use a pen just to point out on what you're explaining.
A pen?
Yeah, there on your Zoom.
On my Zoom. Is there a pen somewhere on my Zoom?
Yes, you can be pointing on what you're explaining because sometimes I get lost.
Yes, that's what I'm asking. Educate me. Where is the pen? Because I need to find the pen first. Where can I find the pen? Can somebody help us? Is there a pen here that we can use? If you
No,
know where the
madam,
pen is, just let me know.
Madam, it's like you use a cursor, not a pen.
I use the cursor. Okay, okay.
Yeah.
All right. If it is the cursor, then I know what the cursor is. If it is the cursor, I know what the cursor is. Yes, as I was saying, can you see my cursor?
Yes, we're seeing it. We're seeing it.
You can see it.
Yes.
Okay, fine.
Yeah.
All right. So yes, I was saying, Shafiq, this is the returns outwards journal. Okay. This is the format of the returns outwards journal. It has a title, it has a date, it has details. These are the people. So returns inwards journal. These are the debtors. The details are the debtors that have returned goods to us. This is the credit note upon which the goods have come back. This is the reference. For example, the creditor Smith we can find in the sales ledger number 17 or page 17. For John, we can find on the sales ledger page 20. And this is the amount that, or the value of the goods that have been returned. So for example, John returned goods on a credit note 24. The reference is sales ledger number page 20. And John has returned goods worth $155. Okay, are we together? Shafiq, are we together?
Yes, madam.
Okay. For the returns outwards journal or the purchases returns, we still have dates. We have the account that will be debited. Okay. Remember, these are our creditors. So for example, account payable or creditor called Karim and Sons is going to be debited, or this particular account is going to reduce. This creditor is going to reduce, so we are going to debit. Account payable or creditor called Maria, Wahid and Company are going to be debited by this amount or that amount for Karim, okay? So that's what it means. These are the entries. This is the journal. This is where we journalize. This is where we journalize. After we journalize, this red arrow shows we post to the ledger. This one also shows that after journalizing in our returns inwards journal, we shall get the total and post it to the ledger accounts. These are the ledger accounts. In the ledgers is where we debit and credit. In the day books or in the journals, we just record each transaction as it takes place. Now, I want to go to this particular source document. Anybody has a question about the credit note or the debit note? Okay. Yes, Mark. Do you have a question?
Yeah.
Mm.
On the other thing of return, I haven't yet gotten you on the other thing because I was on and off.
Mark, I also didn't get your question.
The other question, like on the
Yes.
previous thing you have been showing us.
Yes.
I was on and off the network. Yeah, on that thing of return inward and return outward.
Now, Mark, I'm going to repeat for the last time, but try and catch up, okay?
All right.
Sendoga, why do you want to control my screen? We have what we call credit notes. Sometimes credit notes are known as credit memorandums or credit memos. We have outgoing and incoming credit notes, okay? Incoming credit notes are issued for purchases returns or returns that we are taking back to our suppliers or returns that we are making to creditors or returns against purchases or returns against stock or inventory. Please mute your mics. Please mute your mics. You see, if you do not do that, you're wasting your own time. You're not wasting my time. Yeah, I'll keep quiet and wait for you to keep quiet so that I can talk. It's as simple as that. I cannot control you from all the way here. You either control yourselves or I keep quiet until you can control yourselves. So as I was saying, this incoming credit note, sometimes in other books is known as a debit note. It simply is an acknowledgement that the supplier has received your goods or has received the returns that you have made or that you purchased and afterwards returned. And therefore you have to make an adjustment to your creditors because your creditors now have gone down because you have returned some goods or you have returned some of the purchases that you made. Once you have that source document, which is called a debit note, you input the information on the debit note into a book or a journal that is called a returns outwards journal. Okay? And I've given you an example you can see on the screen of what this book looks like. It has a date, it has the customer, it has the creditor, it has the debit note number, it has a reference, which will probably be in the ledger, and then the amount that is going to be reduced against the creditor. Once you have this information, for example, here we have information for July. We have returns outwards on the 14th. We also have returns outwards on the 27th. You add up this amount, which is 285. If you add up this amount here, okay? It's 285, probably these are dollars, okay? So you will post this sum to the ledger using these accounts. You reduce your liabilities by debiting them, and then you open up a new account called a returns outwards or purchases account.
But madam, stop disturbing us.
Okay, yes, some interesting conversations going on. So we continue. Now, the outgoing credit note is a document that is sent to debtors to show that we acknowledge that we have received goods back from them. So those are returns inwards. Once we get that source document, we open up a book called a sales returns inwards journal. If it already exists, you don't have to open it up. You just go there and input the information on the credit note. This is what it looks like. You have a date. You have that data that has returned goods. You have the note number upon which you have received the goods, the folio number, which is a reference for the original transaction where you sold the goods to the debtor, and then the amount of the goods that have been returned. You get this particular summary at the end of the month and post it to the ledger accounts. When your debtors are reducing, because it is an asset, when it reduces, we credit. So that's why we credit the debtors here. We open up a new account that we call a return inwards journal. I will, as I told you earlier on, this is a reduction on your total sales. So in your income statement where you have sales, you'll have to deduct a little bit of the sales returns. So that is it about this particular slide. I would like to continue to the next slide. Check. A check is also a source document. What does it show? A check shows payment. It shows an unconditional order to pay a certain person or to pay a certain entity, and it must be signed. By signing it, you're authorizing the bank to pay a certain entity or a certain person. This person is called a payee. The person that you're paying by check is called a payee. Now here you have an example of a check from the State Bank of India. The payee name is the person that you're going to pay using the check. Usually it has amount in words. You write the amount in words here. You write the amount in figures here. Sometimes you have to write the date for yourself here. Then you sign. Everybody who's supposed to sign on this check signs here. Sometimes you have 1, 2, 3 people who are supposed to sign a check. All of them have to sign here. In this case, it was signed by one person, Mr. C. Hadant Jain. And then usually this one is the account number. It is usually printed on a check. You do not have to write it. It usually goes with the check. And that is all that an account, the checkbook looks like. Now, if you want to open a check, usually you must sign in this blue space. If you're more than one signatory on the account, all people should sign within the blue space to open up the account. So there are 2 signatures. One will be here under signature and one will appear within the blue space here. So that is what a check looks like. Now, a check is also a source document to show that a transaction has taken place. It shows that you have made payment to a certain person. Sometimes when you're the one receiving the check, it shows that the person has paid you using a check. Receipt. A receipt is also a source document that shows proof of payment of either goods or services. And it's usually prepared by the person that is receiving the cash, showing that they have received cash. Now, this is an example of a receipt. It's usually part of a bigger book, which is called a receipt book. In certain businesses, they have a point of sale receipts. They do not have a book. They have those point of sale machines. I hope you have seen them when you go to the supermarket. It just automatically prints the receipt on certain paper that is rolled inside. It's called a point of sale. So a receipt, it usually has a receipt number, cash that was received from and for the purpose and the date and the total amount that is received. Okay. So that is also a source document. Once we receive cash, we input it into what we call a cash book. And we're going to look at a comprehensive cash book probably on Wednesday. So once we receive cash, we enter it into a cash book, okay? Once we pay cash, we shall also enter that into a cash book. So we have also what we call a cash memo. A cash memo is also a source document. Now, a cash memo is different from a cash receipt. Now, where's the cash receipt? This is the receipt, this is the memo, okay? So the cash memo is different from a receipt because it contains details. It contains details like number of sales, the price of goods, the applicable discounts, if there's any sales tax, all those things are on the cash memo, okay? So that is the difference between the cash memo and the cash receipt. The cash receipt only shows proof of payment. The cash memo goes into the detail of the number of sales, the price at which you sold, the rate, also the price, the quantity, the description, if there are any discounts, any taxes, all those will be shown on what we call a cash memo. Now we also have what we call a remittance advice note. A remittance advice note comes from your customer. It comes along with, it is something that advises you on how much, for example, a debtor still owes you. So it might come along with a check, and the advice note will say that I am paying a certain invoice number, this, and I'm paying this amount, and I'm paying it by check. And here is the check, it is attached to the remittance advice. So an example here, we have a remittance advice note from Champion Sports Fairway. We have a remittance advice note from Chairman Sports Fairway, okay? This is probably a debtor. This debtor received an invoice number 3189. The invoice was valued at 480, but probably Champion Sports returned goods to us. Remember, a credit note is for returns inwards. A credit note is for returns inwards. So Champion Sports Fairway is telling you that they returned goods to you with a credit note number 118. And therefore, they're going to pay you 480 minus those goods that they returned, valued at 86.40. Swagger Manoa, please mute your mic. So they're advising you that the invoice that you sent them for goods valued at 480 is going to be reduced by the goods that they return to you using a credit note of 886.40. Probably this is in dollars or pounds, I don't know. Oh, leads, it might be pounds. So they're going to pay you this amount. So they're advising you that they're going to pay you this amount, okay? And probably this remittance advice came along with a check for 393.6 pounds. Please, Kabira, get a hold of your mobile or whatever device that you're using. Who's Rubama Fahad? If you're part of my class, please stay in class. I don't know what you're doing or what you're up to. So that is a remittance advice note. They're advising you on how they're remitting money to you, okay? And these are probably debtors. So they're advising you on the way that they're going to pay and how much they're going to pay and against which invoice or which credit note that they're going to pay you. Questions about this so far before I continue to the next? Okay, so we continue. Other things, yes, Wendy Rashidi.
Yes, teacher, first explain about the remittance advice.
A remittance advice note is just a note that is sent to your business from your customers about what they're paying you, how much they're paying you, and against what they're paying you. So probably they took goods on credit. So these are our debtors and they would like to pay. So they send you an advice note showing you how much they're going to pay, against which invoice they're going to pay, and probably by a reduction of a certain amount that is written in a credit note, maybe they return goods to you. So they show you the deduction on their invoice and they send it along with the payment. So they can send it along with cash or they can send it along with a check to pay. As simple as that. Yes, Nixon.
Yes, madam. How simply can I understand remittance in simple terms?
What is remittance in English?
In other words, that's what I've asked.
Yes, what is to remit money? Okay. But I'm talking in terms of English now. What does remit mean? Nixon, are we together? Okay. To remit means to send money. Okay. Let me just do a quick scan for you here. Let me share this so that you can see it. To remit money means to, where is it? You should be seeing my new screen. It means to send money. Can you see my screen? My new screen?
Yes, we can see it.
Yes, my screen. Remittance dictionary. Can you see that?
Yes, we can see it. We can see it.
A sum of money sent in payment. When they say I'm going to remit money, it means I'm going to send money. Okay? Who sends money?
Yes.
Debtors can send money. Okay? Us as a business, we can also send money to our creditors. Okay? Are we together?
Yes, madam.
So when we receive a remittance note or a remittance advice note, that means that our debtors are advising us on the money they are sending us. They are advising us against which invoice they are sending money. They are advising us against which returns they are probably reducing the amount they are going to send us. They are also telling us the mode in which they are going to pay us. Probably they are going to send the money with a check, okay? So they are advising us against money that they are paying the debtors. Are we together? Are we together?
Yes,
Yes, we're
madam.
together. We're together.
Okay.
I get you. I get you.
Okay, are we back to the PowerPoint? Can you see my PowerPoint?
No, we're still seeing the former screen
No,
of
no,
remittance.
we haven't. No, really.
We're not seeing the PowerPoint, madam.
It's
We're now
now
seeing
there.
it. It's
Yes,
now
you can
there.
see it.
Okay. Now see.
Okay. So we go to orders. Specific. There are purchases orders. There are also sales orders. When your supplier receives your purchase order, so you can initiate a purchase order. You send a purchase order to, let's say, Plum Stationery. XYZ sends a purchase order to Plum Stationery. This purchase order specifies that I would like 100 counter books. They must be blue bound. They must have 200 pages. They must be delivered in bundles of 10, and I want 200 copies. So that means I expect to receive 20 bound copies of 10 each of all these books that are blue and so forth and so on. Specifics. Those are things that you put on a purchase order. You send it to Plum Stationery. Plum Stationery internally will raise what we call a sales order. Okay, so XYZ sends a purchase order to Plum Stationery. In Plum Stationery, they use your purchase order to raise something called a sales order. And it is this sales order that they send to either production or whatever team is in charge of sales, and then they arrange for the delivery of these goods. Why do we need a source document called a sales order? We need a source document sales order in order to trace the invoice. Okay, so once the invoice comes, I will check indeed I ordered for 200 books. They were supposed to be bound in blue. They're supposed to have 200 pages each. They're supposed to be in bundles of 10, and they're supposed to be 20 bundles. So your sales order or purchases order helps you to keep track of your purchases. It also helps you to keep track of your sales, and it is something that can help you follow up an invoice. So once I'm looking at the invoice, then I'm looking at indeed what I ordered is what has been delivered, and it is what I am going to pay for. So that is why you need, that is the importance of sales orders and the importance of purchases orders. Then we have what we call goods dispatch note. Now, once you have the sales order, then you send the goods for delivery. The goods come along with what is called a goods dispatch note. So let's say that these goods are coming from the warehouse of Plum Stationery. The warehouse of Plum Stationery will issue a goods dispatch note, meaning that the goods have been sent out for delivery, okay? And the person that is receiving the goods at XYZ company will receive this goods dispatch note showing what has been delivered, who has delivered it, and it will also be signed by the person who has received, okay? So it helps you to track that you actually made delivery of the goods that had been ordered. So XYZ cannot come and claim that they did not receive the goods because you have evidence using a goods dispatch note. They signed for the goods that they had received them at their premises of XYZ. Yes, somebody has a question. What is your question? No question, can I continue? Okay, so a goods dispatch note helps, is a source document that helps a business keep track of where the goods have been taken, how much of the goods have been delivered, and whether actually they have been received in good condition. So before you receive any goods, that you have ordered. Make sure you check them, that they are complete, that they're in the right condition before you sign the goods dispatch note, because it can hold you accountable in certain aspects, especially when we're talking about accountability. Benita Bleak, it is better if you just remove your video. Thank you very much. Okay, so it can also be used to back up invoices or claims of undelivered goods, because somebody signs for receiving the goods, so you can easily trust that you actually made the delivery. Now, a pay-in slip. What is a pay-in slip? You're very familiar with this because I'm sure you go to the bank to pay tuition, or you have gone to the bank one day or another day to pay something. Yes, James.
Madam, can we take a look over a goods dispatch note?
You want to do what?
Can we take a look on the goods dispatch note, like the other note they give you?
Yes, that one will be your homework, James. Please go and find out what a goods dispatch note looks like. Okay? Go and do that homework. Go to Google, type in goods dispatch note, you look templates, and you see what it looks like. Okay? Then a pay-in slip. A pay-in slip is basically evidence. It's a source document, and it shows evidence or proof that you deposited money in the bank. Okay? Now, usually you fill in a document that looks like this. When you go to a bank, usually there's a document that looks like this. It has two parts. You see this line going down? Usually the bank gives you this part to take away, and then it stays with this part of this slip. On this slip, you usually put a date, you put the account number where you're depositing the money, you put the name of the account holder, their telephone number, if any, then you put the amount that you're depositing, then you write the amount in words. Sometimes here they put name of depositor. You put the name of the person who's depositing. Then here you put the denominations of the cash that you're depositing, or sometimes it is a check. So you will put here probably 50,000 notes. There are 5, so it is 50 times 5. Getting how much? 50,000 times 5 is what? 250,000, being the total here. And then you fill in the same thing, the account number, the denominations here, you put the date. This is also account number, the name of the account, the mobile phone, the email, the amount in words. If it's a check, you put the check number here, and the bank where the check is coming from, and how much is on the check total, and then signature of depositor. So usually the bank stays with the larger part of the pay-in slip, and they give you this small part. Now, after you have paid or deposited money, what the bank will do is usually they'll stamp this part, they will stamp it, and then give it to you. Now, certain banks have revolutionized. They have gone beyond using this particular paper. You just go give them the money and give them the account which you would like to deposit money on. And then after they deposit it, they give you a slip, which is printed from their computers. So you do not need to fill in this form. So sometimes you need this form. Sometimes they just give you a form printed from the bank. That is what is called a pay-in slip. It is a source document, proof that you have paid money into the bank. Now we need this proof when we go back to look into the cash book, which we'll probably look at on Wednesday or next week. So in the cash book, there will be things like you credit the cash book, and then you debit the bank. What that means, and we look at these entries, we call them contra entries, is that money has moved from the cash into the bank. It still remains your asset. It's just that one asset called cash is reducing and the other asset called bank is increasing. So we need evidence such as a paying slip to show that you actually moved cash from the money from the cash till into the bank. So this will be an evidence for that. Yes, so in brief, what are the types of journals? Or what are the types of books of original entry? Or what are the subsidiary books? We have the general journal. In the general journal, we record transactions that are not recorded in any of the other journals, okay? They don't fit within sales, they don't fit within purchases, they don't fit within cash, they don't fit within returns inwards, and they do not fit within returns outwards. Now, for your homework, I would like you to go and find out what are some of those transactions that are not journalized in the sales day book, they're not journalized in the purchases journal, they are not journalized in the cash book, they are not journalized in the returns inwards, nor are they journalized in the returns outwards book. Those transactions shall be recorded in the general journal. So remember, just to recap our class for today, the sales day book, also called the sales journal, records credit sales. The purchases day book, also called the purchases journal, records purchases bought on credit. Okay? The purchases day book, also known the purchases journal, records our trade creditors. Then we have the cash book. The cash book records cash in, cash out. We're going to look at that in detail. The cash book records cash you've received. It also records cash that has gone out. The returns inwards day book returns sales that have been returned into the business. Returns inwards day book or returns inwards journal records sales returns or returns from our debtors or returns that have been bought back into the business or sales returns. The returns outwards day book, also called the returns outwards journal, records transactions relating to purchases that we return to suppliers. Okay? So those are the types of journals. And for your homework, go and find out the other types of transactions that can actually be recorded in the general journal. But also, you also have the other two exercises that I told you about. The exercise of the sales day book and the exercise of the purchases day book. Okay? All right, so these are other documents that you can look at. Some of them are similar, but this is a summary of all and others. So you have sales invoices, purchases invoice, credit notes, debit notes, petty cash voucher, cash receipts, bank statements, memorandums, ATM receipts. ATM receipts, you know these things. I'm sure most of you have bank accounts. This is point of sale receipts that I talked about that you usually find in supermarkets. The point of sale receipts, supplier statements, bank deposit slips or forms, payroll records, cancelled checks. We're going to look at that once we get to bank reconciliation, how the cancelled checks come in. So for your homework, please do what I've told you to do. On Wednesday, I think we shall do the general journal. The general journal and probably the cash book as well. But yes, questions about today's lecture. I will take questions about today's lecture. Yes, Eston. You can unmute yourself.
Good morning.
Yes, good morning.
Is a dispatch note the same as a delivery note?
Yes, it is the same.
Okay. And maybe the other thing I would like to know, can you please get us some other sample questions on how these things are set in the exams?
Okay, I will do that.
Okay, thank you.
Yes, Kashaka. Nathan, unmute yourself and ask your question.
Madam,
Basically, the thing is, I've attended this morning.
Eston, please mute yourself.
Madam,
Yes, Kashaka.
I was asking whether it is possible for us to get copies of what we have gone through so that we can also go through them. If possible.
I did not hear you.
Is it possible for us to get soft copies of the work we have gone through so that we
Yes, I
can
am going to send you the document after this class.
Okay, ma'am.
Nairuba Margaret.
You're going to send us.
Yes, good morning. Kashaka, please mute yourself.
Madam, I was suggesting, can you please send us the slides before the lectures?
I'm going to send you before the lecture.
Yeah, so that we have them before we have the lecture.
Okay, fine, I will do that.
Okay, thank you.
Yes, Mujisha Mark. You can unmute yourself. Okay, Chris Daniel, unmute yourself. You can ask your question. Okay, Lugwama Fahad, unmute yourself and ask your question.
Morning.
Yes, good morning.
Madam, can you be clear on the exercises you've left behind because my network was disturbing?
Yes, you're going to do an illustration of the sales day book, and also you're going to do another illustration of the purchases day book. You will see them in the slides.
Okay, thank you.
Yes, Ida Chris, what is your question? It seems Chris has no question. Is there somebody else? Lule Stephen?
Madam.
Yes, please.
Good morning, madam.
Good morning.
I was just asking, when are we in and how are we going to hand in?
When are you?
When are we handing in and how are we going to hand in the work?
It is your personal work. You don't need to hand it in. It is your personal work. I do not need it. It's your own homework. Yes, Swaga Manoa.
Madam, good morning.
Good morning.
I'm getting a certain challenge.
Yes.
Like in group B, we were somehow left behind. And I don't know how.
Yes, the lecturers in group B are going to teach you this afternoon. So you can attend the afternoon class.
Okay, madam.
Yes. Ruakidin Patrick. Unmute yourself and ask your question.
Good morning, madam.
Good morning.
I wanted to ask you, are we going to use this data on screen for the illustration?
Yes, and I'm going to send it to you.
Okay, thank you, madam.
You're welcome. Anybody else with a question I haven't answered? If I have not answered your question, you can unmute yourself and ask your question.
Yes, madam.
Yes.
Madam, I want to know whether, okay, like those illustrations, to know whether I'm right or I'm wrong.
Okay.
So how should I know that I'm doing the right thing or the wrong thing?
Who's this?
This is Wendy.
Yes, Wendy, we shall start with your screen on Wednesday. You can share your screen and we see what you've done. Okay? Is that okay?
Yes, madam, it's okay.
Yes, you'll share your screen and we see whether you've done the right thing or not. Mugabe Edgar. Unmute yourself and ask your question.
Morning, madam.
Good morning.
Like for my belong to the group B,
Mm-hmm.
and am I free to change to group A because the time they gave us it is not convenient to me.
It is fine. You can study in whichever group you want. Because we are studying online, the numbers don't matter. Only you can attend any group. You can attend however many times you want. You can attend both groups. It doesn't really matter.
Okay, thanks.
If I haven't answered your question, you can just unmute yourself. Otherwise, I see everybody here. I think I have answered your questions. Who's the class representative again? Is it Christine? Christine and somebody else. Is it Trevor?
Yeah, it's called Trevor.
So I am going to send the document to your Gmail. I think you have a Gmail account. I'm going to send it right now. Please share it with the class so that the
Yes,
class
we
can
have.
go through those numbers. And also do the homework as well. So I'm going to send it in the next 2 minutes. Please share it with the class. I will see you on Wednesday. I will probably send you the slides for Wednesday's lecture tomorrow. So there's somebody who wanted the slides before class. I will send them tomorrow for Wednesday's class.
Thank you very much, madam.
Okay, have a nice day.
Okay.